Tonight, viewers are watching closely as one of the most powerful institutions in the United States makes a move that could influence the daily lives of millions of people. The Federal Reserve has taken a step that is drawing the attention of economists, political leaders, and households alike, a small but significant adjustment to its key interest rate. What does this mean for families balancing credit card debt, for young people navigating student loans, or for anyone trying to buy a home or save for the future? The story is about more than numbers. It is about power, politics, and the ripple effects that stretch from Washington to kitchen tables across America. For the first time in 9 months, the Federal Reserve is lowering its benchmark interest rate, trimming it by 1/4 of a point. At first glance, this modest cut may not sound like much. Yet, in the complex machinery of the American economy, such decisions often set off chains of consequences that touch everything from auto loans to savings accounts. For many households already under financial strain, even a small shift could offer either a glimmer of relief or a new challenge. But behind the numbers lies another question: will the Federal Reserve be allowed to remain independent? Or is it being pushed and pulled by political forces? President Donald Trump has repeatedly clashed with Fed Chair Jerome Powell, even urging his resignation and moving to undercut Fed Governor Lisa Cook. This raises alarms not only about the credibility of U.S. financial policy but also about how political pressure can influence an institution meant to rise above it. To understand what this rate cut means, it is necessary to explore the real-world consequences. Let us begin with something many Americans rely on every day: auto loans. Auto financing has been stubbornly expensive. Rates for new cars average around 7%, while used car loans remain even higher, over 10%. These figures have barely budged in recent months, despite broader signals of economic slowdown. For many families, buying a vehicle is already a stretch. With tariffs expected to push car prices upward, financing becomes an even heavier burden. Lenders weigh a host of factors: credit scores, loan terms, down payments, and delinquency levels before approving loans. As delinquency rates rise, lenders become stricter and interest rates climb. That reality makes access to a car loan increasingly difficult, especially for borrowers with weaker credit profiles. Industry experts advise consumers to prepare carefully. Before heading to a dealership, prospective buyers should secure pre-approval from a bank or credit union. This gives them leverage when negotiating, ensuring they compare dealer financing against outside offers. It is a reminder that negotiating the total price of the car, rather than focusing only on monthly payments, is crucial to avoid hidden costs. Credit cards tell another part of the story. With the average rate hovering around 20%, carrying a balance has become a costly habit for millions of households. A cut by the Fed could, in theory, lower these rates slightly. Yet credit card issuers are rarely quick to pass along savings. It may take months before consumers notice any change on their bills. And even then, much depends on credit scores and card types. Reward cards, for example, often carry higher than average rates. This is where consumers need to take initiative. Regulators recently pointed out that major issuers tend to charge much higher rates than smaller banks or credit unions. That difference can add up to hundreds of dollars per year for the average cardholder. Experts recommend shopping around and even calling current card issuers to demand better terms, armed with proof of lower offers available elsewhere. If a balance transfer is considered, it is important to examine fees and the eventual rate jump when promotional periods expire. Mortgages, the cornerstone of homeownership, add another layer of complexity. Rates on 30-year fixed loans recently settled around 6.35%. This is lower than the previous week, but still higher than a year ago. Unlike auto loans or credit cards, mortgage rates are not directly tied to the Fed's benchmark. Instead, they move in relation to 10-year Treasury bonds, which reflect inflation expectations, investor behavior, and central bank policies. Analysts believe rates may hover closer to 6% by the end of the year, but they remain well above the lows many buyers enjoyed in recent decades. For homeowners and buyers, the lesson is to shop aggressively. Quotes should be gathered on the same day from multiple lenders, with close attention paid to annual percentage rates, discount points, and FEs. Adjustable rate mortgages and home equity lines of credit, however, are more sensitive to Fed changes, meaning households with those products may see adjustments within a couple of billing cycles. What about savers? The era of high-yield savings accounts may be starting to cool. Online banks had been offering rates of 4% or more, but these returns are slowly easing as the Fed adjusts course. Traditional banks continue to lag far behind, with average savings accounts paying little more than 0.5%. Certificates of deposit and money market funds are also inching downward, though selective shoppers can still find competitive yields. Savers must now weigh not only rates but also deposit requirements and FEs, ensuring they do not give up hard-earned returns through charges or restrictions. Student loans bring yet another angle to the conversation. Federal loans, which remain the first choice for most borrowers, are fixed at the time of borrowing and recently dropped slightly. Undergraduate loans now stand at 6.39%, graduate loans at 7.94%, and plus loans at 8.94%. The changes are modest but mark the first decline in 5 years. Private loans, meanwhile, remain unpredictable. They often require consignors, vary between fixed and variable rates, and hinge heavily on credit scores. For students and parents, navigating these options demands careful comparison shopping and an understanding of long-term repayment costs. These shifts may feel subtle, but they reveal how closely tied everyday financial life is to decisions made in Washington. From the price of a new car to the bill on a credit card statement, from the mortgage payment on a family home to the savings account used for emergencies, the ripple effects of Fed policy stretch across the nation. Still, the political backdrop cannot be ignored. The Federal Reserve has historically operated independently, shielded from short-term political demands to maintain long-term stability. Yet with the president openly criticizing and attempting to influence the institution, questions arise about how independent it truly remains. Economists warn that politicizing the Fed risks undermining confidence both at home and abroad. If investors or foreign governments begin to question America's commitment to stable, unbiased monetary policy, the cost could be far greater than any single rate adjustment. As these debates unfold, households are left to adapt. Some will benefit from slightly lower borrowing costs, while others will see savings erode more quickly. The challenge is to stay informed, to seek out better deals, and to remain vigilant as policies shift. This is not simply a story about interest rates. It is a story about how Americans live, spend, and save. For viewers, the key takeaway is clear. Do not assume that small policy shifts are irrelevant. In the long run, these changes accumulate, shaping the financial landscape for years to come. As experts note, the real test will be whether the Federal Reserve can continue to act with independence and credibility in the face of mounting pressure. This is a moment to watch closely, and it is a story that will continue to develop. The next decision from the Federal Reserve may bring more relief or new challenges, and its consequences will be felt far beyond the walls of Washington. If you found this report useful, remember to like this video, share it with others who may be navigating these same financial questions, and leave your thoughts in the comments. What changes are you seeing in your own financial life? Are credit card payments becoming more manageable, or are mortgage rates still putting homeownership out of reach? Your perspective is part of the national conversation, and together we can better understand how these decisions affect us all. Stay with us for continued coverage as the Federal Reserve navigates this critical moment in economic history. The numbers may shift, but the stakes remain high, and the implications for American families are profound.